We've got a headline today that is, it's pretty much designed to make you do a double take. It involves one of the biggest names in finance, and the numbers are just completely contradictory until you start digging in.
They really are.
So today, we're diving deep into the Goldman Sachs Q4 2025 earnings. And here's the paradox, right at the core of the report.
Okay.
Goldman's net revenue actually dipped 3% year over year. A decline. That sounds like a problem.
Look, it does.
But at the same time, their net profit jumped a phenomenal 12%, completely shattering Wall Street's expectations.
Yeah, it just blew them away.
So how do you shrink your top line and then aggressively boost your bottom line at the exact same time? It looks like accounting wizardry.
It does, but it's really a story of, well, strategic retreat meeting, just an absolute operational triumph.
Our mission today is to cut through that confusion, the high-level accounting, figure out what Goldman is actively trying to get rid of,
Right.
and reveal the business segment that just broke a Wall Street record, proving the firm still knows exactly where its bread is buttered.
And this is a great deep dive for you, the listener, because the firm's strategy is, well, it's hidden in the details. Our source material is a detailed analysis of their financial reports. We aren't just reading a press release. We're trying to extract the core strategic drivers.
Looking at where the money is really going.
Exactly. Where management, led by David Solomon, was truly placing capital for the future. We're helping you understand that hidden story behind the massive profit surge.
Which, like you said, involved a lot of cleanup.
A great deal of strategic cleanup. But before we get into that cleanup, let's just hit the high point, because it sets the stage for everything.
Okay.
Goldman Sachs' stock trading business, specifically their equities desk, achieved a single quarter revenue of $4.31 billion.
Wow.
That is not just a strong quarter. That's a new historical revenue record for the entire street.
The whole street.
The whole street. That's the kind of performance that just changes the narrative.
$4.31 billion from stock trading in just 3 months. That is a stunning number.
It is.
But it also creates the tension we need to address first. Let's go back to that top line confusion.
Right.
The raw numbers. Q4 net revenue, $13.45 billion. That's the 3% year-over-year drop. Yet their net income was $4.62 billion, the 12% jump leading to earnings per share of $14.01, up 17%.
It just doesn't add up on the surface.
It doesn't. In a functioning business, less revenue usually means less profit. So what specific factor hit the revenue line but then somehow bolstered the profit line?
That's the critical question.
Yeah.
And the answer is rooted in a major one-time accounting move.
Okay.
It's all tied to their decision to exit the consumer banking space. The key culprit dragging down net revenue was a segment called Platform Solutions.
Platform Solutions, that's where they kept the consumer loans, the Apple Card partnership, all of that.
Exactly. And that segment recorded a net negative revenue of $1.68 billion in Q4.
Wait, negative revenue, how does that even work?
Well, that massive negative figure was the anchor that pulled the entire firm's top-line revenue down. A number that big tells you they were taking a huge hit to get rid of something.
A write-down.
Well, a huge write-down. If you look deeper at that negative $1.68 billion, the sources show it included a $2.26 billion asset impairment.
So that's the cost of just admitting the consumer experiment failed.
That's it. They're writing down the value of those assets to get them off the books.
Yeah.
And the high-profile example, of course, is the Apple Card.
Right.
The sources confirm this was all largely triggered by the final stages of transferring that business over to JP Morgan. They just ripped the Band-Aid off.
They did. But how does ripping that Band-Aid off lead to more profit? That's the paradox.
Okay, so here is the essential accounting nuance for you. Profit relies on revenue and expenses. And banks have a huge expense category called credit loss provisions.
Money they set aside for loans they expect to go bad.
Precisely. Reserves for anticipated defaults. So when they write down the Apple Card assets and get them off their books,
They don't need the reserve anymore.
they don't need the provision they had previously set aside.
Yeah.
The very same move that caused the revenue drag allowed them to release $2.48 billion in those credit loss provisions.
So they were basically able to say, we thought we might lose this money, but now that the loans are gone, we can take it back.
That is exactly it. And that $2.48 billion provision release instantly acts as a positive contribution to net profit. It flows straight to the bottom line.
An accounting gain.
It's an accounting gain.
Yeah.
So the $2.26 billion write-down hits one side, but the related $2.48 billion reserve release instantly boosts net income. That one mechanism pushed the net profit up 12%. It was a one-time cleanup quarter.
Okay, that makes perfect sense now. It was a strategic cleanup, clearing the decks even if the headline looked weak. So if we strip out that accounting impact,
Yes.
you're saying the underlying operational performance was actually substantially stronger.
Absolutely. And that brings us to the segment that wasn't hiding behind any accounting maneuvers. Let's talk about the genuine powerhouse of the firm, Global Banking and Markets.
Or GBNM.
GBNM. This is where Goldman has always excelled, and it's where they generated all their real momentum.
Let's talk about that growth. GBNM total revenue hit $10.41 billion in Q4. That's a 22% increase year over year.
A huge jump.
Investment banking M&A capital raising was incredibly strong. It grew 25% to $2.58 billion. That's a new fourth quarter historical high for that division.
Right, and the sources even note that investment banking fee reserves also increased from Q3.
Which signals that activity isn't slowing down. They have a strong pipeline.
A very strong pipeline of deals waiting to close. But if we zoom in on what truly defined this quarter, it was the trading floor. That equity trading business, it wasn't just a great quarter, it was an outlier.
Okay, so this is the record you mentioned.
This is the record. That $4.31 billion revenue figure didn't just beat analyst expectations. It surpassed the firm's own previous record, which was set just 2 quarters earlier.
So they beat their own all-time high.
They did. This reconfirms their undisputed position as a top-tier institutional trading bank globally.
What was the catalyst for that? Was it just market luck, or were they capitalizing on specific trends?
It was capitalization. The sources point to 2 primary drivers. First, consistently strong institutional client demand.
Meaning hedge funds, pension funds?
Exactly. Major asset managers.
Yeah.
They were all extremely active in Q4, and they funneled that activity right through Goldman's desk.
And second driver.
Performance in the derivatives business. Derivatives are complex, often high margin, and Goldman clearly executed flawlessly in managing and structuring these products for their clients. They capture huge profits from that volatility.
That strong performance in equities raises a question for me, though. Yes, $4.31 billion is fantastic.
Yeah, right.
But doesn't relying so heavily on market volatility create instability down the line? It's a boom and bust cycle.
It absolutely introduces volatility, and that tension is the very reason we saw the strategic pivot in the rest of the report.
Okay.
To finish the picture on GBNM, it's worth noting the fixed income, currencies, and commodities business, FICC.
FICC, yep.
That also generated strong revenue at $3.11 billion, up 12% year over year. So they saw strength across the entire trading spectrum. One analyst basically said GS reproved its unparalleled advantage in the institutional business.
They're just the best at this high-stakes game.
They are.
Which brings us back to the other side of the equation, the exit from consumer banking. That negative revenue number wasn't an accident. It was the expensive declaration that the consumer experiment is over.
That is the definitive story of the full year. After trying to build a mass-market digital bank, they realized the capital drain and the low margins just weren't worth it.
Not compared to the institutional business.
Not at all. So the platform solutions drag was the firm ripping the bandage off to refocus on margins. And this refocus means all eyes are now on asset and wealth management.
Or EWM.
IWM. This segment posted stable Q4 revenue of $4.72 billion. But the real story here is the sheer scale they've achieved.
Okay, so give us the scale. How big is this arm now?
Their assets under supervision, or AUS, reached $3.61 trillion by the end of Q4. Trillion. $3.61 trillion. That is a massive pool of capital generating reliable, recurring fee income. And crucially, they saw $116 billion in net inflows during Q4 alone.
Wow.
$66 billion of that was in long-term assets. This is essential because those fees provide the stability that balances the unpredictable nature of the trading division. It's the bedrock.
And here's where it gets really interesting for me and proves their commitment. Management didn't just praise the wealth division, they substantially raised the future financial targets for it.
They did. It's a huge signal of ambition.
For the AWM segment, the pre-tax profit margin goal was aggressively increased from the mid-double digits all the way up to 30%.
30%. That is an ambitious number, even for Goldman.
And the return on equity goal was also raised from mid-double digits to the high double digits.
That kind of target hike tells you they're extremely confident in their ability to monetize those assets.
Where does that confidence come from?
It's rooted in strategic investments. The sources highlight moves like acquiring the ETF issuer Innovator Capital and the venture capital firm Industry Ventures.
So they're buying the capabilities they need.
Instantly accelerating them, allowing them to charge higher fees across a wider range of high-value products. It all fits into this dual strategy.
Shedding the low-margin consumer baggage while aggressively pursuing the highest-margin institutional and wealth clients.
Exactly. It's a return to pure focus.
Yeah.
Management explicitly said it's about building a more balanced, more resilient business portfolio.
A symbiotic relationship.
Right. Wealth management provides the dependable cash flow, allowing their trading arm to take the necessary risks to achieve those record-breaking numbers.
And when a firm does all that, the cleanup, the profit beat, the strategic confidence, they reward shareholders. We saw a huge vote of confidence when the board announced a dividend increase of 12.5%.
From $4 a share to $4.50, starting in Q1 2026.
That's a nice hike.
It is, but the total capital return story for the whole year of 2025 is even more staggering. Overall, they returned $16.78 billion to shareholders.
$16 billion. How did they do that?
Two main avenues: $12.36 billion in stock repurchases, which took almost 19 million shares off the market.
A big buyback.
A very big buyback, showing they think the stock is undervalued. And the other $4.42 billion was in dividends.
Okay, but are these changes happening on solid ground? Are they financially stable enough for all this?
They're extremely well capitalized. Liquidity is robust, with average global core liquid assets at $479 billion.
And their capital ratio?
Their key regulatory metric, the CET1 capital ratio, is sound at 14.4%. That's well above the minimums and gives them plenty of runway to pursue these new growth targets without strain.
Okay, so let's unpack this and summarize. This deep dive has revealed that the contradictory Q4 headline was really the result of two different forces. The unexpected profit was driven by that accounting cleanup freeing up provisions from the consumer exit, and that was paired with a genuine record-breaking performance from their core institutional trading engine.
A 1-2 punch of accounting and real performance.
And secondly, the firm is fundamentally redefining itself. They're shedding the consumer burden, refocusing on high-margin institutional services, and aggressively growing wealth management.
Which is symbolized by those new 30% profit margin targets.
They're doubling down on what they've always done best: high finance for the highest net worth clients.
The sources show a company making calculated strategic moves that clarify its identity. But this raises the ultimate critical question for you, the listener, to consider.
Okay.
Given Goldman's commitment to its core trading business, which just set a record, and its aggressive new targets for wealth management, we're relying so heavily on the inherent volatility of that trading arm, even when it's successful. Will that inevitably undermine their long-term goal of achieving a more stable income base through wealth? Or are these two highly profitable sectors so fundamentally intertwined that the wealth division simply cannot hit a 30% margin target without the massive scale and distribution power provided by those record-setting trading desks?
That structural reliance is the ultimate challenge they face moving forward. Thank you for diving deep into the numbers with us.
My pleasure.
We'll see you next time.